those things. I mean, on any given day, 2 million shares of Coca-Cola may trade. That's a lot of people selling, a lot of people buying. If you talk to one person, you hear one thing, and talk to another. You really should not make decisions in securities based on what other people think. If you're doing that, you should think about doing something else, because a public opinion poll will not get you rich in Wall Street.
And we ignore 99.9% of what we see, although we run our eyes over them. And then every now and then we see something that looks like it's attractively priced to us as a business. Forget about the word stock. So when we buy a stock, we would be happy with that stock if they told us the market was going to close for a couple of years. We look to the business. It's exactly the same way as if you were going to buy a farm a few miles here outside of Omaha. You would not get a price on it every day, and you wouldn't ask, whether the yield was a little above expectation this year or down a little bit. You'd look at what the farm was going to produce over time. You'd look at the expected yields, you'd look at expected prices, the cost, taxes, the cost of fertilizer, and you would evaluate the intelligence of your purchase based on what the farm produced relative to your purchase price. Quotes would have nothing to do with it. That's exactly the way we look at stocks. We look at them as businesses. We make judgments.
Well, I'd say no, but I'd say it's in the nature of things that the market is not going to do exactly what you want when you want it. I think over time, Mr. Market will treat the Berkshire shareholders fine, and I wouldn't worry too much about what happens over this 6 months or this 12 months. I don't think you're really all that welcome in this room if the short-term orientation is what turns you on.
Stocks, the beauty of stocks is they do sell at silly prices from time to time. I mean, that's how Charlie and I have gotten rich. Ben Graham writes about it in Chapter 8 of The Intelligent Investor. Chapters 8 and chapters 20 are really all you need to do to get rich in this world. And Chapter 8 says that in the market you're going to have a partner named Mr. Market. And the beauty of him as your partner is that he's kind of a psychotic drunk. And he will do very weird things over time. And your job is to remember that he's there to serve you and not to advise you. And if you can keep that mental state, that all those thousands of prices that Mr. Market is offering you every day on every major business in the world practically, that he is making lots of mistakes. And he makes them for all kinds of weird reasons. And all you have to do is occasionally oblige him when he offers to either buy or sell from you at the same price on any given day, any given security. So it's built into the system that stocks get mispriced. If you have a temperament that when others are fearful, you're going to get scared yourself. You are not going to make a lot of money in securities over time in all probability. People really, if they didn't look at quotations, but of course the whole world is urging them to look at quotations, and more than that, do something based on small changes in quotations. But if you didn't, think how much more rational, we've talked about it before, but think how much more rational investing in a farm is than the way many people buy stocks. I mean, if you buy a farm, do you get a quote next week? Do you get a quote next month? If you buy an apartment house, do you get a quote next week or month? No, you look at the apartment house or the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. But they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more. Ben Graham wrote about it. It's been explained. But if you can't get yourself in that mental attitude, you're going to be scared whenever everybody else is scared, and expect somebody else to tell you when to buy and therefore get your courage back up or something. I could get this fellow's courage up substantially by saying it's a wonderful time to buy, and then a week from now he'd run into somebody else that tells him the world is coming to an end, and he'd sell. I mean, he's a broker's friend, but he's not going to make a lot of money. Charlie?
Yeah, I think I developed more courage after I learned I could handle hardship. So maybe you should get your feet wet with a little more failure. Is that how brief these opportunities to take advantage of dislocations frequently are. Some idiot hedge fund bought unlimited municipal bonds at incredible margins. I think they bought 20 times more municipal bonds than they could afford with their own money, borrowing all the rest. And when those things were dumped on margin calls, municipal bonds suddenly got mispriced in America. But the dislocation was very brief.
But very extreme.
But very extreme. And so if you can't think fast and act resolutely, it does you no good. So you're like a man standing by a stream trying to spear a fish, and the fish just comes by once a week or once a month or once every 10 years. And you've got to be there to throw that spear fast before the fish swims on. It's a pretty demanding business if you do it right.
Many also believe that value investing does not apply to China, where the stock market just doubled over the last 6 months.
I certainly think investment principles do not stop at borders. So if I were investing in China or any place else, India, UK, Germany, I would apply exactly the same sort of principles that I learned from The Intelligent Investor. I would think of stocks as a small piece of a business. I would think of investment fluctuations being there to benefit me rather than to hurt me. And I would try to focus my attention on businesses that I thought I understood the competitive advantage they had and what they would look like in 5 or 10 years. So I don't think I would change the principles at all. I'm not sure I got.
He wants to invest less like a lemming.
Oh, I understand that. I was giving you the first shot at it, but I will tell you what changed my own life on investing. I started investing when I was 11. I first started reading about it. I believe in reading everything in sight, and first started reading about it when I was probably 6 or 7 years old. But
for about 8 years, I wandered around with technical analysis and doing all kinds of things. And then I read a book called The Intelligent Investor. And I did that when I was 19 down at the University of Nebraska. And I would say that if you absorb the lessons of The Intelligent Investor, mainly in...
How should they look at stocks when every day in the media, they see companies that have never made a time in their life go IPO, they're dilutive, and they see a lot of very short-term spin. The cycle is getting shorter and shorter. How should they view stocks, and what's your message for them?
You don't have to really worry about, what's going on in IPOs or people making money. People win lotteries every day, but there's no reason to have that affect you at all. You shouldn't be jealous about it. I mean, if they want to do mathematically unsound things, and one of them occasionally gets lucky and they put the one person on television and the million that contributed to the winnings with a big slice taken out for the state, don't get on there. It's nothing to worry about. Just all you have to do is figure out what makes sense, and you look at buying. When you buy a stock, you get yourself in the mental frame of mind that you're buying a business. And if you don't look at a quote on it for 5 years, that's fine. You don't get a quote on your farm every day or every week or every month. You don't get it on your apartment house. If you own one, if you own a McDonald's franchise, you don't get a quote every day. You want to look at your stocks as businesses and think about their performance as businesses. Think about what you pay for them as you would think about buying a business, and let the rest of the world go its own way. You don't want to get into a stupid game just because it's available. And I'm going to say a little bit more about that close to the break. But with that, I'll turn it over to Charlie.
Yeah, well, I think that your children are right to look for people they can trust in dealing with stocks and bonds. Unfortunately, more than half the time, they will fail in a conventional answer. So they really they have a hard problem. If you just listen to your elders, they'll lie to you and spread a lot of folly.
But they really have an easy...
Generally speaking, trying to dance in and out of the companies you really love on a long-term basis has not been a good idea for most investors. And we're quite content to sit with our best holdings.
People have tried to do that with Berkshire over the years. And I've had some friends that thought it was getting a little ahead of itself from time to time, and they thought they'd sell and buy it back cheaper. And it's pretty tough to do. You have to make two decisions right. You have to sell it right first, and then you have to buy it right later on, and usually you have to pay some tax in between. To get into a wonderful business, the best thing to do is to stick with it. Coke and Gillette both experienced disappointments to their management, below what they anticipated a year and a half ago or whenever it was, below what we anticipated. But that will happen over time. It happens with some of our wholly owned businesses from time to time. Sometimes they do better than we anticipate too. But it's not the nature that everything goes in a nice straight smooth line upward. You mentioned Cap Cities. Parts of Cap Cities have done extraordinarily well, for example. But in the network business, if you go back 30 years and look at what network has been on top, you find that no one stays on top or on the bottom indefinitely. It's a competitive world, as I mentioned earlier, and sometimes your competitors' correct moves, your own incorrect moves, the world environment, all of those things can interrupt trend lines. I see nothing that's happened in the last year in terms of the long-term trend line of the blade and razor business, which is the one I referred to as inevitable Gillette. I mean, there are other businesses that are not in the same category as the blade and razor business. Coke, fortunately, has virtually its entire business in soft drinks, and so it comprises almost 100% of the whole there. But I see nothing that would change my thinking about the long-term future of either the blade and razor business or Coke's position in the soft drink business. You don't get paid for activity. You only get paid for being right. Charlie?
Yeah, an occasional dull stretch for new buying, this is no great tragedy in an investment lifetime. And other things may be possible in such an era too. I mean, it isn't like we have a quiver with only one arrow.
We sat through periods before. I mean, the most dramatic one being the early 70s, late 60s and early 70s. For a long time, it doesn't seem so long when you look back on it. It seems long when you're going through it, but it's like having a tooth pulled or something. But it's, what can you do about it? The businesses aren't going to perform better in the future just because you got antsy and decided you had to buy something. We will wait till we find something we like. We'll love it when we can swing in a big way, though. That's our style. Citizens were living, every generation was living better than the one that preceded it. But you had these huge changes, big gains a few times, long periods of stagnation. 20 years, I mean, that's a long time to do nothing. The answer is that investors behave in very human ways, which is they get very excited during bull markets, and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for a huge opportunity, just huge opportunity. I mean, I lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some percent of their new money in stock because they were wild about stocks. Then they got a lot cheaper, and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of the reactions because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime, and securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains, it takes temperament.
General liquid market for common stocks creates from time to time, either in sectors of the market or in the whole market, a Ponzi scheme. In other words, you have an automatic process where people get sucked in and other people come in because it worked last month or last year, and it can build to perfectly ridiculous levels, and the levels can last for considerable periods. Trying to predict that kind of thing, sort of a Ponzi scheme, which is, if you will, accidentally thrown into the valuation of common stocks by just the forces of life, by definition, that's going to be very, very hard to predict. That's what makes it so dangerous to short stocks, even when they're grossly overvalued. It's hard to know just how overvalued they can become in addition to the overvaluation that exists. And I don't think you're going to predict the Ponzi scheme effect in markets by looking at the price of gold or any other correlation.
Charlie and I mean, you're pulling a figure out of the air. We have probably agreed on at least 100 companies, maybe more, that we felt were frauds, bubble type things. And if we'd acted on shorting those over the years, we might be broke now. But we were right on probably just about 100 out of 100. It's very hard to predict how far what Charlie calls the Ponzi scheme will go. It's not exactly a scheme in the sense that it isn't concocted, in most cases, by one. It's sort of a natural phenomenon that seems to nursed along by promoters and investment bankers and venture capitalists and so on. But they don't all sit in a room and work it out. It plays on human nature in certain ways, and it creates its own momentum, and eventually it pops. And nobody knows when it's going to pop, and that's why you can't short. At least we don't find it makes good sense to short those things. But it is recognizable. You know when you're dealing with those kind of crazy things, but you don't know how high they'll go or when it'll end or anything else. And people who think they do, sometimes play in it. Other people know how to take advantage of it. I mean, there's no question about that. You do not have to have a 200 IQ to see a period like that and figure out how to have a big wealth transfer from somebody else to you. And that was done on a huge scale.